Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 109 on April 11th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Haliburton, Advanced Micro Devices, and the iShares Russell 2000 ETF. And we discuss three new trades on Virgin Galactic, Snap Inc., and Caterpillar Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to understand to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for the Weekly Option. Now, this was a short week of trading due to the markets being closed on Friday for Good Friday. The Dow Jones Industrial Average still managed to gain 2,666 points, ending the week at 23,719 points. The S&P 500 index picked up 301 points, closing at 2,789 points this week. Both indices were up approximately or a little bit more than 12% for the week. Now it's time to dive into the topic of the week. And this week, we're going to look at something that many of you have a lot more of right now, and that's time. Specifically, it's the value of time. So in our daily lives, very few people put an appropriate value on their time, right? Yet it's our most constrained resource. We can't make more of it. We can't buy more of it. Time is limited. Well, in finance, we do put a value on time. It's a real number, a real value. And in option trading specifically, time is a huge component in the extrinsic value of an option. So if an option is out of the money, meaning it cannot be exercised for stock shares, all of its value is extrinsic. It's made up of time and then another piece that tries to determine the likelihood of that option becoming in the money before expiration. So another way I look at time is with regards to adjusting trade ideas before expiration. So like last week, if I make a trade that loses money the first week, but there are 3 weeks left before expiration, I have more time to make another trading decision that leads to profit or limiting loss. Now, if I make a trade with 2 weeks before expiration and that trade is down the first week, I really don't have much of an opportunity to protect myself from a loss because there's just no time left. So we'll see that in this week's trade review for sure. I kind of got shellacked this week. I don't know if that's an official word, but at least in this term. But this might make you want to trade options. Some people start to learn more about time, and they say, okay, well, the best thing would be for me to trade options that are 3 or 4 months out, 3 or 4 months away from expiration. Well, having more time will actually make the options more expensive. So there are times in my portfolio where I trade calendar spreads, meaning I'll trade, I'll buy 1 month and sell options in another month on the same name. That trade literally is trading time because the difference in the value of those options, if they're on the same strike, the difference between them is literally the value of time. So to trade options successfully, ultimately, you have to get used to valuing time and manipulating time so that you can create trades that are profitable for yourself. So that's it for this week's trading topic, at least, topic of the week. Let's dive into the trading review from last week. And as I mentioned, this certainly was not my best week's performance, but I also mentioned last week that, with these only being 2-week trades, you're somewhat limited. And this week, the new trades are all going to be next month. They're going to be with May. And if you were to stick with April, there are some opportunities in April, but these are trades that expire in 5 days, meaning you have 5 days to be correct in your direction of the market. And if you're wrong, that's it. Like on Friday, options are either they're either in the money and therefore being valued at their intrinsic value, or all the extrinsic value will be gone at expiration. So they either have intrinsic value and that's what they're valued for, or they're worth zero because all of the extrinsic values have passed once time is out. So we'll start off with the covered call as we do each week. We're looking at Haliburton, symbol H as in hotel, A as in alpha, L as in Lima. At the time the stock was trading for $7.61 a share, we looked at buying that stock and selling the April 8 call at 70 cents, hoping for a maximum return of 14.32% in 2 weeks. Well, Haliburton stock actually grew 60 cents this week, closing at $8.21 per share on Thursday. The April 8 call we sold is now in the money, which means that if you did this trade, you would simply wait for expiration in about a week, expiration on Friday, and you would ultimately lock in 14% return on your capital. So there's no additional adjustments to be made in this short amount of time. Our next trade last week was a credit spread. We looked at advanced micro devices, symbol A as in alpha, M as in Mike, D as in Delta. At the time, the stock was trading for $42.59 per share. I looked at selling the April 43-44 call spread at 42 cents, which could give us a maximum possible loss of 58 cents per spread. Well, AMD stock gained $5.79 per share this week, ending the week at $48.38 per share. The out-of-the-money spread, the out-of-the-money call spread we sold, is now in the money by a couple of dollars. So with 1 week left in the trade, we will likely lose the maximum risk exposure of 58 cents per spread on this trade. Now, I like selling a put spread against a short call spread trade, but the lower strike put spreads right now don't really have any value in them, mostly because of the lack of time. Time's up. Expiration is on Friday. So if you were to sell a put spread with a higher strike than your call spread, then you run the risk of the stock finishing in a position where both spreads are in the money. So let's say you decided to sell, you're like, okay, well, stock right now is $48.38 per share. I'm going to look at selling the 47.46 put spread or the 48.47 put spread. There's some value in those that you could sell and actually limit your loss that you've taken on this call spread. But if the stock price were to finish at, say, $45 per share this week, you'd be in a situation where the put spread is now in the money, the put spread you sold is in the money, the call spread you sold is still in the money. So you actually didn't reduce your risk at all, you doubled it. And that's part of the reason why I talk about understanding risk so much, is because you can look at a trade that makes sense from a financial standpoint, but in the truth of it is you're actually doubling risk rather than reducing it. For this trade, given that there's only 1 week left to expiration, we're going to walk away with the loss. I mean, stock might do something crazy and swing the other way this upcoming week, and this trade still end up making money, but we would need it to finish, we would need it to finish less than $43.42 per share. I believe that was our break-even point last week. So if it doesn't, we'd still be losing on this trade, but that's okay because it's a spread. We knew what our maximum possible loss was right from the start, and every now and then we end up having to take it. Having a defined risk in these trades allows me to approach it with a stoic, sort of non-emotional or unemotional way of looking at my trade and what my next step is. So our next trade from last week, also ending in loss. I hate losing. If you guys listen to this show, you know that. So this is really paining me, or really painful for me. Our debit spread, we looked at the IWM, the iShares Russell 2000 ETF, symbol I as in India, W as in whiskey, M as in Mike. The stock, when we looked at this trade, was $104.62 per share. And I looked at buying that April 106-105 put spread for 64 cents. And that can give us a maximum return of 36 cents or 56.25% return in 2 weeks. But as we know, if you buy a spread, your maximum loss is the amount of money that you paid for it. So IWM stock rallied $19.10 per share this week. ending the week at $123.72 per share. The in-the-money put spread we bought is now way out of the money. So with only 1 week left, the spread will most likely expire worthless unless stock swings the entirely other direction by $19. That means that we have a maximum loss of 64 cents because that's what we paid for. That's what we paid for the spread. So any additional trade that we would make would likely add to the risk of the position rather than decreasing it. And that's the danger of trading options with short expirations. As I mentioned, there's not a lot of time left, so you don't get a chance to make another trade that can hedge or limit the loss on this position. So that's it for the trade review for last week. Let's look at this week's trade ideas. So we'll start off with the covered call. And this is the company I haven't looked at before. Looking at Virgin Galactic Holdings, symbol SPCE. S as in Sierra, P as in Papa, C as in Charlie, E as in Echo. The stock ended the week at $15.27 per share. I'm looking at buying that stock and selling the May 16 call at $1.95, hoping for a maximum return of 17.55% in 5 weeks. So you enter this trade by buying Virgin Galactic stock for $15.27 per share and selling the May 16 call at $1.95. This trade makes the most money if stock prices finish above $16 per share, and the break-even price is $13.32 per share. So in real terms, the stock purchase would require $1,527, and you would collect $195 for selling the option. Our second trade this week is going to be a credit spread on Snap Inc., symbol S as in Sierra, N as in November, A as in Alpha, P as in Papa. Stock ended the week at $13.61 per share. I'm looking at selling the May 13-12 put spread, collecting 33 cents, which gives us a maximum possible loss of 67 cents per spread. So you enter this trade by selling the May 13 put at $1.03 and concurrently buying the May 12 put for 70 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire higher than $13 per share. The break-even price is $12.67 per share. So in real terms, you would receive $33 per spread you sell and have $67 at risk per spread. And then our final trade for this upcoming week is a debit spread. We're looking at Caterpillar, symbol C as in Charlie, A as in Alpha, T as in Tango. Stock ended the week at $125.03 per share, and I'm looking at buying the May 120-125 call spread, paying $3.35 per spread, which gives us a maximum possible gain of $1.65 per spread, or a 49.25% return. Now you enter this trade by buying the May 120 call for $9.70 and concurrently selling the May 125 call at $6.35. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices remain above $125 per share. The break-even price on this trade is $123.35 per share. Now, in real terms, you will pay $335 to enter this spread, and your maximum gain is $165 per spread. And normally on this show, I stick with $1 wide or 50-cent wide spreads. This Caterpillar spread is actually $5 wide. That means $500 in real terms. So you're paying $335, and that's why your maximum gain is $165 per spread. It's because this is a $5 or $500 wide spread. So that's it for this week's trade ideas and the trade review. Thank you guys so much for listening. I hope you are having a wonderful Easter weekend if you celebrate Easter. Otherwise, have a great weekend and happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.